So in Chapter 13 we'll be talking about what at-risk means and passive activity loss rules, as well as the alternative minimum tax. At-risk, this concept was designed to determine how much of a loss an investor, for example, in a trade or business can take. So for example, as the at-risk amount increases, then in the event that their investment or passive investment suffers a loss, they can take a greater loss against a greater at-risk amount. So the initial at-risk amount is any money contributed plus any of the adjusted basis of contributed property. And it is the adjusted basis that is used to determine the at-risk amount. And the reason these at-risk rules were established, in part, was that taxpayers were taking losses against investments, for example, passive investments, that were greater than what they had at stake or what they had at risk or what they had invested in the investment. So these rules, these at-risk rules, are designed to curtail that. So if an investor can increase at-risk amounts, such as by contributing property and cash, if the investment earns income or gains, or if the investor or of the passive activity, for example, agrees to take on risk by virtue of signing on to liabilities. And we'll talk about recourse liabilities shortly. So if they're on the hook for some of the liabilities of the investment, then that increases their at-risk amount, decreases our cash and property distributions, or liquidation of interest, and then a release of liabilities, so you have less at risk in the passive activity. If you cash out partially at least, or if you are released of liabilities. We use Form 6198 then to determine the amount of at-risk for each of these activities. I mentioned earlier that recourse debt means that the passive investor is taking responsibility. They may be a cosigner on the loan for the investment. Well, that increases their riskiness, so that increases the at-risk amount. A non-recourse debt is debt taken on by the investment, but the investors are not on the hook. They're not responsible for the payment of the debt. They're not co-signing on the debt. Therefore, it does not increase the at-risk amount. And then qualified non-recourse debt does generally increase the at-risk amount. This is kind of a specialized category, generally related to real estate or other debt that's secured by collateral. Loss is disallowed under the at-risk rules in the event that an investment's losses are greater than the at-risk amount. Well, then those losses are suspended. Those losses are temporarily disallowed. However, they do carry over indefinitely, so in the event there is greater, the at-risk amount increases in the investment to offset against these losses in the future, they can be applied then at some point when these at-risk amounts increase. It's deducted in the years when the at-risk amount increases, and I'll give you an example of that. As I just mentioned, if, for example, the investor increases their level of investment, if they take on greater responsibilities through recourse debt, if the investment earns money and part of it's attributed to the investor's interest in the investment, these things would increase the at-risk amount in the future, and therefore some of these previously disallowed losses can be used in the future. However, losses may also be subject to passive loss limitations, since that's like a second layer of tests to determine whether or not losses can actually be deducted in a given year. So first they have to pass the at-risk rules. Do they have enough at risk to support the loss? Then they have to pass another rule, and that we call these passive loss limitations. So what is a passive activity? It is generally where a taxpayer does not materially participate, and materially is the operative term here, on a regular, continuous, or substantial basis. For example, most rental activities in limited partnerships. There are 7 tests the IRS uses to determine whether or not an activity is indeed passive. And if it's not passive, it's an active business, then the passive at-risk rules and the passive loss rules would not apply. So, for example, if someone contributes more than 500 hours to a business during the year, then they are considered an active participant, a material participant, more accurately. And so if they're a material participant, then the business is not passive. If they contribute all of the activity to an investment or a business, so all the participation in the business is by one person, irrespective of the number of hours they contribute, then that is a material participation, and they don't have to be subject to these at-risk and passive loss rules. They contribute more than 100 hours or less than any other person, and less than any other person, so both conditions have to be met, more than 100 hours and less than any other person in the business, then it is not passive. 100 hours and several activities that aggregate to exceed 500, so you have several passive activities that may on their own be passive but are aggregated together and accumulate to more than 500 hours, then it is a material participation and therefore not a passive activity. And then there are 3 additional categories or tests that are used, and any one of these, if any one of these are passed, then the activity is material participation and not subject to the at-risk and passive activity loss rules. The material participant for any of the last 5 years and material participant for any of the last 3 years for personal service activities, these are designed for people who at one time were active in the business but are no longer. Well, then they don't have to treat it as a passive activity if they qualify under either of these 2. And then finally a passive facts and circumstances. This one is the least, really the least reliable test because it's very subjective. So it's better if a taxpayer can lean on or use any one of the foregoing or the previously mentioned tests to justify that their participation in a business or trade is material, and again, therefore not subject to the passive loss rules or the at-risk rules. So the passive loss rules, this is that second test I mentioned earlier. The passive loss rules applies after the at-risk rules. And what it says is pretty simple. It says that if a passive activity, that is one that's failed all the previously mentioned tests that we talked about in the previous slide, if a passive activity has no gain for the year, for example, then, and that is in any passive activity, then there can be no passive losses taken even if they met the at-risk rules. So if someone is invested in several passive activities, and if all these activities produce no gains, then no passive losses can be taken. If, however, some of the passive activities do make money, then passive losses from other passive activities can be used to offset those passive gains. They can only be used to the extent of those passive gains or passive income and no more. So in a sense, and I'll demonstrate in some problems in another video, in a sense we're really tracking 2 things: the at-risk disallowed losses and the past suspended passive losses, that is, losses that cannot be fully used in the current period. So income or loss are generally separated into the 3 categories: active income, such as having a job and drawing wages or salary; portfolio income, such as interest and dividends; and then passive income, such as real estate, investment in S corporations or partnerships, limited partnerships. And it is the case that passive losses cannot offset portfolio or active income, with one exception relating to real estate, which we'll talk about. So rental activities are usually passive. Real estate professionals exception, however, that is to say, if a real estate agent or someone is engaged in the profession of real estate and renting property, that's what they do for a living, then it would not be considered passive. Otherwise, generally, rental activities are considered passive. There are some other cases where you can rent something and it's not considered passive. It's actually part of an active business. If you rent, the rental period is less than 7 days, 30 days or less, and significant personal services are provided, extraordinary personal services, incidental to non-rental activity, customarily available during defined business hours, such as a golf cart at a golf course, rented to an entity the taxpayer owns. None of these would involve a passive activity, and therefore would not be subject to the at-risk and passive loss rules. This is the exception I mentioned earlier regarding the rental of real estate activities, and we'll pick up here on the next video.